Hello everyone, welcome to the channel, the Plunger God. So today I'm gonna share with you more towards option basic series on credit spread. So what is credit spread? A credit spread is an option strategy that involves the selling or purchasing of option of the same type, call and or put with the same expiration but different strike price. So the trader receives a net credit when opening the position. So objective is profit from time decay and stable price movement while limiting risk. So there's two main type of credit spread. So one is called bear call spread, and you look in another one will be bull put spread. So from the name of it, it's a bear call. So kind of like you are going for downward direction, but it's a call spread. That means to say, how do you do downward direction but using call? And another one will be upward direction using put. So how do you construct this will be selling a call at a lower strike and buy a call at a higher strike, so slightly higher. So protect your upside, if protect you from any surge in upside movement. Because you sell a call, you want price to go down. So the buy call will protect the surge in terms of the upward movement of the price. So use when expecting price to stay below the short strike. So you want to collect the full premium. It's like you selling call. But when you do this, you bought a call higher to protect your upside movement, so you won't be exposed to unlimited losses. So your buy call is to limit your losses. Put it that way. So bull put spread. Sell a put at higher strike, buy a put at a lower strike. So basically where you did a debit spread and this is a credit spread is totally opposite of the direction of how you want to construct it. Okay, so because when you sell a call or a put nearer to the underlying price, you collect more premium. So you collect more premium, you buy, because the options to buy a call or a put is slightly further, you use cheaper price to buy. So you collect more money and you use lesser money to buy a protective directional move. And end up you collect a credit. So use it when expecting price to stay above the short strike. That is for put spread. Okay. Example for bear call spread. Underlying XYZ. XYZ is just an example. It's not any symbol or anything that represent a stock ticker. Okay. So sell one XYZ call for $4. So if you buy one XYZ for 105 call for $2, that means to say you net credit a $2 per contract. So maximum profit $2 because you collect the $2, and maximum loss is $3 because you collect $2, and the spread for 100 to 105 is $5. So minus away your credit collected $2, so that is your maximum loss that you can lose for this trade. So if your break even is 102, so anything above 102 you start to lose money. That's what they say. So anything below $100 you make the full $2. Okay, so bull put spread. So underlying XYZ at $100 is sell put for at $100 for $4, and you buy $95 put for $2. So you net credit a $2. Maximum profit $2. Look up here. Credit received $2. Maximum loss is $5. Your $100 minus 95 is $5 minus 2, which is $3. It's simple math. So break even point, $100 minus 2 is 98. So anything below 98, then you start to incur losses. So understanding the P&L curve, the P&L curve start from zero. Oh, sorry, start above zero, initial credit. So you collect credit first. So you start, as the price stay within a range, you collect premium on a single day. Like, you get you realize the premium every single day when you sell a credit. So beyond break-even, loss grew until capped at max loss. So max loss is the distance between your two strikes. Ideal when price moves sideways or slightly in favor. So not much of a volatility. You want the price to move a little bit higher. Not much. Yeah. You just want the not much movement. So time decay, theta and option grid. Theta, positive time decay work in your favor. Delta, negative for bear call, positive for bull put. So you're slightly confused here because bear call, you want the price to goes down. So you sell a call nearer and you want it to be realized to profit by the price staying below the sell call price. So you are a bearish movement for this. And you see bear call. So bull put is your bullish movement by using put. Selling the sell put nearer to the strike or nearer to the underlying price. Then another buying put is further away from the underlying price. So Vega, negative falling volatility benefit credit spread. So you want to sell it when the volatility is high. Once it crashes, then you straight away collect a lot of premium. That's what they're trying to say. So Gamma, lower sensitive to rapid movement near expiration. Okay, so the lower, the better, because you want it to expire worthless. You don't want it to expire near the money, at the money. No, you want it to be far, far away, as much as possible. A good distance, I would say. So implied volatility, IV impact. So high IV, expensive option, better for premium selling. So you can be able to get a better premium during market crashes if you do a bull put spread. So enter credit spread when IV is high and expected to drop. Falling IV, post entry enhanced profit potential. So falling IV, so you want to buy sell at high IV. So post selling or you already done it, then you want the IV to go lower. Then suddenly you can collect a lot of premium. Yeah, so this is the curve for spread. So ignore the factor event. So this is normal curve. See credit spread. So this is where the price move. This is for a bear call spread. So the price move downwards. You want it like, for example, -5 value, right? So you want to collect the premium, you want it to be near zero. So near zero, that means to say you can, if you sell your option, then you only need $0 to buy back the option to close, $0 to close. So as much as possible, you want to see the negative lower. Okay, over time. Yeah. So advantage and disadvantage. Advantage of it is define risk and define reward. High probability of profit when price stay within the range. Actually is above or below the range. You don't want to be within the range. You want it to be above your sell put strike so you can collect the full premium, and below your sell call strike to collect the full premium. So benefit from time decay and IV drop. So I want to adjust here high probability for profit when the price stay below the call range or above the put range. That's more correct. Yeah. So disadvantage will be limited risk potential, requires good risk amount, requires good risk management. Because your R2R is not in your favor, you collect 200, and your maximum loss is 300. So in a way whereby you have to be more correct in terms of the direction. We cannot sell anywhere that you want, and after that, the price be in the money, and you start to lose money, right? So you want it to be slightly above your selling strike price or below the selling strike price, so they can collect the whole full premium. So you have to do a bit of risk management here. So loss increase sharply if price move through the strike. Okay, because usually when it's in the money, the delta increase, and when the delta increase, you start to lose money especially when the DTE is nearing. DTE means date to expiration. So if you have a little date or a little time left, then you start to see a very big swing in your P&L. Okay, so when to use credit spread? So ideal condition will be small directional or sideways movement, high IV environment. It can be before earnings or post earnings, whereby the heavy sell off or whatever. Those very driven, news driven, will create a lot of IV or futuristic, or when the price move violently, they also have to create a very high IV environment. So that will give you a high premium collection. So define risk profile preferred. Because define risk profile, that means to say you know how much you're gonna lose if it doesn't work in your favor. And you also know how much you're gonna make if it's in your favor. So avoid is when IV is low premium collection. Expected moderate or big movement in the market. So just now, the previous video, we talk about debit. Right now, we talk about credit. So we do a little bit of comparison of debit and credit. So category, market outlook. So debit will look into directional. So credit will look into neutral. Cash flow, pay premium, collect premium. So net debit, net credit. Objective, profit from moderate price movement, profit from time decay or stable price. Risk, limited to premium paid and limited to strike difference minus away the credit. Reward. Limited to strike difference minus debit, and whatever you get is whatever you get. That will be the reward. Implied volatility, best to enter at low IV and best to enter at high IV. So you want to sell premium at high IV. Theta, work against you, work for you. Ideal scenario, you expect a strong but controlled movement for debit, and credit, you expect a price to stay within a range. You don't want it to move too much above the sell put and below the sell call. Example, bull call, bear put spread. So what are the example of strategy? Bull put, bear call spread. Okay, so this is pretty much clear on what's the difference between debit and credit. Summary and key takeaway. Credit spread are excellent for sideways or small directional movement. Profit from premium collection, high IV setup. Understanding grid and monitor data decay, great strategy for traders seeking for consistency, controlled exposure. So credit spread equals to collect premium for range bound outlook, so sideways movement. That's what they're trying to say. Not the price within this strike. To collect money, they want the price to move sideways. So you sell far away, a little bit far away from the range bound. So define risk to reward. Choose based on IV trend and volatility expectation. So great for trader seeking for control exposure and limited risk. Okay, so that's all for credit spread. So let's look at some example. So example will be how you want to construct a, a backhaul spread. So in backhaul, that means to say you want to sell nearer to the underlying. So you sell here, 636, then you buy here, 638. Because the market isn't open right now. So for example, you will collect about 0.1 cents and your exposure is $2. So what's the risk to reward ratio? You collect 0.17, you minus away $2, which is 1.83. So it's pretty much high risk. You might not want to take the risk unless you are very, very sure, very, very certain. If not, you are collecting 17 cents and you might have a loss potential of $1.83. Not ideal. Because the price is very odd-legged due to the fact whereby the market, the premium is not updated. The live price is updated, but that wasn't the closing price for on Friday. So I did this on Monday. That's why you can see that this is the risk to reward is not in favor. When market opens, the price refresh, the premium collected should be a lot higher than 17 cents. It's just an example for you. Okay. So when you do a bull put spread, so how you want to construct a bull put spread? Like for example, I will construct at 631, then $2 spread. You see here, you collect about $1 for $2 movement. So it's like 1-to-1 ratio. $2 minus 1, then 1-to-1. As I mentioned, this option pricing is due to market close and the market already shifted at pre-market. This price is our Friday price, not today live price. That's why you can see why is it so good. $1. Okay, so that's all for today. Hope you understand and able to get a very good understanding about the credit and debit spread. And if you have any question, just leave your comment below and I will try my best to answer everything. Okay, so safe trade and thank you very much for watching. Please, if you find this information helpful, please like and subscribe or share with your friends. Okay, thank you very much. See ya.